Hey everyone, and welcome to this explainer. I am absolutely thrilled you're here. I've been helping students navigate the CMA syllabus for years, and let me tell you, I know exactly which topics can feel like a massive hurdle. Actual versus normal costing? Yeah, it's a classic one. But don't worry, I care deeply about making sure you walk into exam day feeling totally confident, so we're going to break this down together step by step. By the end of our time today, you are going to absolutely master the nuances of how we track costs throughout the production cycle. So let's just dive right in.
So put your manager hat on for a second. Imagine you're running a custom furniture shop and you need to price a bespoke dining table, like today. Now, you know exactly what you paid for the raw wood, right? And you know exactly what you paid your workers on the factory floor. But do you know exactly what your factory electricity bill or the factory insurance is going to be for this specific hour of work? Honestly, probably not. You won't actually know that for weeks. And this is a massive practical dilemma. Waiting for perfectly accurate actual data can literally paralyze your decision-making. I mean, you can't just put your entire business on hold, waiting for the mailman to deliver an invoice. To help you conquer this concept, here's our fast-paced roadmap for today's explainer. First, we'll look at the pricing timing dilemma. Second, we'll put actual and normal costing head-to-head. Third, we'll calculate the overhead rate. Fourth, we'll tackle under and over-applied overhead. And finally, we'll wrap up with your essential CMA exam key takeaways.
All right, kicking things off with Section 1, the pricing timing dilemma. Now, you might think, especially when you're studying for an exam, that we always want purely actual numbers. It sounds right, doesn't it? But here is the fundamental conflict. Actual costing is perfectly accurate, sure, but it is just incredibly slow. You simply cannot price a product efficiently if you have to wait until the end of the month for every single utility bill to show up. Normal costing, on the other hand, it relies on a smart estimate. So you're sacrificing just a tiny bit of perfect historical accuracy to give yourself something way more valuable: speed. It's what actually keeps the business moving forward. Which brings us right to Section 2, actual versus normal costing. To really get how these two methods work, we've got to look at the three pillars of product cost. Notice how direct materials and direct labor align perfectly between both approaches. In both actual and normal costing, we're using the actual, real-world historical costs. The big divergence, literally the only difference between these entire systems, happens in that bottom row. Actual costing uses actual manufacturing overhead, but normal costing, it uses budgeted or estimated manufacturing overhead. And honestly, this brilliantly illustrates why actual costing causes so many headaches in manufacturing. Think about it. Overhead includes fixed costs, like your factory rent. Let's say your furniture shop produces 10 tables in January, but boom, 50 tables in February. If you use pure actual costing, your unit cost is going to swing wildly from month to month, just because that fixed rent is being spread over a different number of units. Normal costing completely solves this. By using an estimate, it smooths out those seasonal volume fluctuations. It stabilizes your product costs and lets you make immediate pricing decisions. This is exactly why most companies and your CMA exam focus so heavily on normal costing. So, now that we know why we estimate overhead, let's jump into Section 3, calculating the overhead rate. CMA candidates, lean in, because this is a very high probability calculation for your test. Because normal costing uses an estimate for overhead, we need a mathematical rule to apply it. We call this the predetermined overhead rate, or POHR for short. To calculate it, you just take your estimated total manufacturing overhead cost and you divide it by the estimated total quantity of your allocation base. What's an allocation base? Well, it's just the driver we use to assign the cost, usually something like direct labor hours or machine hours. Notice a really critical word here: estimated. We are setting this rate before the year even begins, based entirely on our expectations.
Let's ground this in a practical example for your furniture shop to make sure it really sticks. Imagine you're reviewing the budget for the upcoming year. You expect that your total manufacturing overhead, all those indirect factory costs like electricity and insurance, will be $100,000. And based on your production schedule for those tables, you expect the factory to run for 10,000 machine hours.
Simple math, right? $100,000 divided by 10,000 hours gives us a predetermined overhead rate of exactly $10 per machine hour. Think about what this actually means in practice. Every single time a dining table spends 1 hour on that machine, bam, you immediately charge or apply $10 of overhead costs to that product. You don't wait for the insurance or electricity bill to hit your desk. You charge it $10 right then and there, and you keep production moving. Of course, as accountants, we do have to face reality eventually. That brings us to Section 4, under and over applied overhead. Here's the catch with normal costing. Because it relies on an estimate set at the beginning of the year, the amount of overhead you applied to your products over the last 12 months is almost never going to perfectly match the actual bills you pay at year end. So what happens if you're underapplied? Say you applied $90,000 to your products throughout the year using your $10 rate, but when the actual bills arrived, they totaled $100,000. Yikes, you didn't charge your products enough. To fix this, you have to increase your cost of goods sold. On the flip side, what if you're overapplied? What if you applied $110,000 to your products, but the bills were only $100,000? You were a little too conservative and charged your products too much overhead. In this case, to fix the error, you actually decrease your cost of goods sold. So what is the exact accounting treatment when you hit year end and those T accounts don't perfectly balance? Here are the practical steps you absolutely need to know. Step 1. If the difference between your applied overhead and your actual overhead is immaterial, meaning it's just a really small amount, we keep it simple. You just dump the entire difference directly into cost of goods sold to clear it out. Step 2. If the difference is large or material, you can't just hide it in one account. You must accurately prorate that difference across your work-in-process inventory, your finished goods inventory, and your cost of goods sold based on their ending balances. All right, we've covered the theory, the math, and the year-end reality check. Let's wrap this all up in Section 5, CMA Exam Key Takeaways. I want to give you the absolute highest value guidance directly for your test. If you only take a mental snapshot of 3 things today, make it these. First, remember that actual costing uses actual costs for all 3 components, but it is rarely used in practice due to severe delays. Second, normal costing uses actual direct materials and actual direct labor, but applies estimated manufacturing overhead. And third, guys, here is your ultimate exam cheat code. If a multiple choice question asks you why a company prefers normal costing, scan the answers for 2 magic words: timeliness and smoothing. Normal costing provides timely information, and it smooths out volatile unit costs. You've done a fantastic job mastering normal costing today. But before we go, I want to leave you with a provocative thought. If normal costing improves our business by estimating just one thing, overhead, what do you think happens if we decide to estimate everything? Direct materials, direct labor, overhead, the whole shebang budgeted in advance? Well, my friends, that is called standard costing. And it's the next massive topic waiting for you in your syllabus. So keep setting hard, remember to always keep those T accounts balanced, and I can't wait to guide you through our next topic very soon.